April showers persist, and with a net worth of $250 million, investment manager Cathie Wood could make it rain pretty hard in another context. She wouldn't have to worry about flooding, given she's built a very sturdy ark. This ark isn't filled with animals, rather a beastly portfolio. A beast that reigns as champion of actively managed, exchange-traded funds with under $15.83 billion in total assets, and a total portfolio that includes about $37.59 billion in managed securities reported in ARK's latest 13F filing. ARK's year-to-date total return as of October 31st, 2020 was an astounding 81.19%. Wood anticipates compounding in the low 20-something% range in returns for the next 5 years. The firm went from having $3 billion worth of ETF assets at the end of 2019 to having $34 billion by the end of 2020. $16 billion in cash flows outside of the US ETFS brings the assets to the $50 billion I mentioned earlier. ARK's $15.83 billion in assets under management climbed from less than $3 billion at the start of the 2020. That money wasn't made overnight. Wood leverages 40 years of business to use ARK as a profitable platform for innovation and redefining market research. Through an open approach that cuts across sectors, market capitalizations, and geographies, Wood and the 25-person team she leads believes that ARK can identify large-scale investment opportunities in the public markets. They analyze results from technological innovations centered around DNA sequencing, robotics, artificial intelligence, energy storage, and blockchain technology. In short, disruptive innovation is the name of ARK's game. Disruptive innovation is basically finding new ways to use old products and/or new products to make a new market to replace the old one. Doing so creates value off a first-mover advantage. Prior to ARK, Wood spent 12 years at AllianceBernstein as CIO of Global Thematic Strategies, where she managed over $5 billion. Cathie joined Alliance Capital from Tupelo Capital Management, a hedge fund she co-founded, which in 2000 managed approximately $800 million in global thematic strategies. Prior to her tenure at Tupelo Capital, she worked for 18 years with Jennison Associates LLC as chief economist, equity research analyst, portfolio manager, and director. Wood demonstrates a strong track record. This video runs to the present, where, as mentioned at the start of the video, success continues. Let's get to the heart of the video, which answers what comprises ARK's portfolio. The stock that literally and figuratively sits in the driver's seat is Tesla. As of April 22nd, the stock makes up 10.59% of the ARK Innovation ETF. Wood has championed Tesla's stunning potential for a long time. Why? On a basic level, Wood classifies her style of disruptive innovation as looking for controversy and volatility. Tesla certainly embodies it. But nobody represents the controversy creates cash moniker than Tesla leader Elon Musk. Let's dive beyond fundamentals into more specifics of why Wood favors Tesla and how she is able to comprehend the futuristic company's innovations better than any other investors. ARK analyst James Wang came from Nvidia, impressed at the artificial intelligence chip Tesla was developing. In fact, Wang was so impressed, he declared the chip is at least 3 years ahead of all other competition. A few months later, innovation spurred an influx of positive growth. Tesla achieved a cash flows growth of $1.4 billion during Q3 2018. The achievement surprised analysts who predicted Tesla would sing a different tune, to the broke bellows of losing $2 billion during the span. Why is Wood on target when many other industry experts miss the mark? Well, Tesla certainly isn't the easiest or most traditional stock in the world to analyze. It's not a pure technology stock, but it is at the forefront of innovation technology. Tesla isn't a pure car company, but it creates state-of-the-art cars that drift through the cutting edges of performance and possibility, particularly in the autonomy and energy conservation department. Speaking of energy, Tesla is a big player in the battery game, which is considered in the utility sector. Basically, there's versatile methods behind Musk's madness that produces something for everyone. The abundance of diversity leads to a lack of specialization other investors need to realize Tesla's potential. ARK is an exception. ARK doesn't break research terms by classic sectors, i.e. a finance analyzer, commodity, industry, etc. ARK divides by innovation platforms instead. ARK assigns 4 analysts across diverse sectors, all collaborating on Tesla's robotics, automotive autonomous vehicles, robots, energy storage, electric artificial intelligence, and transportation as a service. Performance, possibility, and preparation led to bold prediction. Wood placed a price target of $4,000 per share to Tesla in 2019 on the unsteady heels of Tesla's rollercoaster 2018. That rollercoaster keeps ascending to the thrills of investors riding ARK and Tesla. In January, Tesla hit $800 per share, which equates to $4,000 pre-stock split. As I said, Tesla drives the ARK Innovation ETF. Let's talk about the top 9 other stocks along for the lucrative ride. Teladoc Health rides shotgun, ranking number 2 in holdings at 6.16% of the portfolio. It aligns with Wood's signature characteristic of investing in disruptive innovation. Again, disruptive innovation is basically finding new ways to use old products and/or new products to make a new market to replace the old one. Doing so creates value off a first mover advantage. The company does this just as the name implies. Patients call a board-certified doctor 24/7, who is available through phone and video consultations. Teladoc reached the wider investment world's radar recently after JP Morgan analyst Lisa Gill revealed the virtual healthcare services company remains her top pick for 2021 in the healthcare technology and distribution sector. As usual, Wood stayed ahead of the curve, holding a stock position since Q2 2019. If the third stock is the charm, then Square shapes a smile on Wood's face. The shapely stock ranks third at 5.87% of the portfolio. Wood has held Square ever since establishing a 13F for ARK's main fund in Q4 2016. In this case, loyalty pays off. Square gained a return of over 200% in 2020. Although it hasn't skyrocketed this year, it is up a decent 12.62% year to date. Despite the name, it's a pretty cool company on the brink of technological innovation, like most of Wood's favorites. Square is a commerce ecosystem. The company enables its sellers to start, run, and grow businesses. It combines software with hardware to enable sellers to turn mobile devices and computing devices into payments and point-of-sale solutions. Basically, it serves a commerce ecosystem and convenient middleman for modern payment processing. Sounds complicated, but is super necessary. Nobody wants to write checks constantly like that grumpy grandma who still thinks Apple is just a fruit. That grandma probably says, "Get off my lawn" a lot. If she was a smart investor, she might also tell Wood to get off the Roku investment, which is the 4th largest holding in the main portfolio. Going back to our little Apple reference, Roku bites into 5.49% of ARK's portfolio. Roku enjoyed a sweet year-to-date return of about 41% earlier in the year. Why? Roku capitalized on extreme usage increases from people looking for indoor entertainment during COVID. Active accounts are up 59%, adding 14 million users last year. The millions keep on rolling. Roku was also up to 51 million streaming hours, a number up 55% from before. The latter number is particularly important since Roku depends on ads. Obviously, more streaming hours translates to more advertisements playing. To that end, the average revenue per user increased 24% to $28.76. That's a lot. By comparison, Netflix's revenue per North American user is $13.51, albeit the Netflix customer base is far larger. On the flip side, the marriage of COVID and indoor streaming increase is on the rocks with wide vaccine availability. So the honeymoon with investors is over. That 41% return in February sank to a little over 5% currently. That number trends down, so Wood acted accordingly, selling 70,000 shares of the streaming platform recently. The hit is likely collateral damage from Netflix's report disclosing disappointing subscription growth numbers last quarter. Clearly, industrial risk rears its ugly head here. There's nothing ugly about the prospects of online real estate company Zillow. The virtual real estate king rounds out the top 5 at 3.71% of the portfolio. As consumers house hunt, Wood isn't the only top investor hunting for Zillow shares. Another millionaire investor this channel frequently covers, Chamath Palihapitiya, loves Zillow too. The stock soared 650% last year. Shares of the Seattle-based online real estate marketplace are already up 50% this year. Zillow posted revenue of $789 million, down 16% from a year earlier, but well above both the company's guidance range and the street consensus forecast at $74. 2020 strengthened the whole real estate industry. Page per property views on real estate platforms like Realtor and Zillow rose over 50% in 2020, while housing's days for sale on the market and the gap between list to sale price dropped too. Although economic recovery means less people will need to sell their houses, more money circulating in the economy means people are more willing and better able to buy. Zoom fails to buy a house, but it has become a household name in the COVID era. In fact, it serves over 460,000 establishments with more than 10 employees. As businesses closed, the financial heavens opened for Zoom last year. The video communications company reported fourth quarter net income of $260.4 million or 87 cents a share, compared with net income of $15.3 million in quarter 4 2019. Overall for the fiscal year, Zoom reported adjusted profit of nearly $1 billion, $995.7 million to be exact, after barely clearing $100 million in adjusted earnings in the previous year at $101.3 million. The company added more than $2 billion in revenue, growing to $2.65 billion from sales of $622.7 million the year before. The rocket may fly lower now with businesses opening up and people returning to physical locations. However, the app opened traditionalists' eyes to the stronger than thought power of remote productivity. That leaves fuel for the stock to still rise, especially in a time of mutated COVID strains entering the United States. Johnson & Johnson pulling back its vaccine. The world isn't ready to zoom out of Zoom just yet. Baidu isn't anywhere near a household name unless your house is occupied by people versed in international internet service and artificial intelligence companies. However, it is the 7th largest position in the ARK Innovation portfolio at 3.16%. In the words of Ron Burgundy, it's kind of a big deal. In fact, it's the largest AI and internet searches in all of China. Baidu extends its considerable tech reach by also delving in cloud computing, mobile phone apps, and even announcing this month it'd pour $7.7 billion into smart card development over the next 5 years. Given the rapid growth of the electronic vehicle market and the world-leading manpower capabilities China possesses, Baidu could become quite a force to be reckoned with. Baidu needs to dodge several landmines before it can achieve that status. Among the explosive threats are heavy competition, the extremely real possibility of being delisted from Nasdaq as a consequence of being caught in distrust that created the new Holding Foreign Companies Accountable Act. The act imposes heavy auditing and watchdog scrutiny from the United States on companies that SEC requests. The aforementioned scope of Baidu makes it a prime target. Shopify takes the 8th slot at 3.14% of the portfolio. Many experts agree that it will be a leading digital commerce company very soon that perfectly fits the archetype, see what I did there, of disruptive innovation. It certainly brings controversy via mixed reviews across consumers. Volatility exists at a beta, risk relative to the market portfolio of 1.44. The market portfolio's risk is 1. Love or hate Shopify, it certainly suits Wood's style. On the flip side, millions sing the praises of music streaming company Spotify. The stock takes up about 2.96% of the portfolio. It's no wonder Wood sings the music streaming service's praises. It experienced a sonic boom of usage during the pandemic, growing over 20% year to year with 345 million active monthly users and 155 million premium subscribers. Even when the COVID mood stops, the music never will. Spotify sports better armor to deflect damage other booming apps absorb as the world reopens. We all need some music to tune out Karen complaining about the coffee machine being broken for the 20th time in 20 minutes. Last but not least in the science world is Exact Sciences, comprising 2.93% of the portfolio. The company races for the cancer cure. The core sounds better than the short-term financials. The stock is down 2% on the year. The earnings per share also terrible, and as expected, the stock is highly volatile. If it can reach the finish line, or at least run to a big breakthrough, this seemingly odd and overconfident stock pick will prove to be genius. All of these holdings are for ARK's Innovation ETF. It's worth noting Wood aligns with active trading, and ARK has a database to keep. That is only one of 7 ARK ETFs. 7 proves to be a lucky number once again. The aforementioned ARK Innovation ETF enjoyed a 2020 net asset value gain of 152.51%. The Autonomous Technology and Robotics ETF gained 106.70%. ARK's Next Generation Internet ETF logged a 157.08% gain. The Genomic Revolution ETF, led in NAV 2020, gains at 180.50%. The ARK FinTech Innovation ETF rounded out the actively managed ETFs, rising 107.92%. All these ETFs smashed the S&P 500 index's year return of over 18%. ARK features two index ETFs that also performed well. The 3D printing ETF gained 40.37% in NAV. Crossing continents maintained the same high standard of success. The Israel Innovative Technology ETF gained 35.24% NAV. That stands for Net Asset Value. Net asset value is the per share value of a mutual fund stock bond and cash reserve holdings. In summary, Wood and ARK are swimming in the money, and its ways to get it will make your head swim. Hopefully this video won't do the same. If so, feel free to dislike this video and leave us a snippy comment telling us to cover simpler stuff next time. If you enjoyed learning something new, hit the like button. Either way, consider subscribing for more informative business content.